Hi everyone, I'm Basil Nilamra, tutor for financial reporting. In this video, I'm going to debrief section A of FR pre-September 2024 mock exam, which is available in ACCA practice platform. So as you know, in section A, there'll be 15 objective type questions, and each question is worth 2 marks and total 30 marks for objective type in section A. So let's start with the first question. In the first question, if you read the requirement, it says in accordance with IAS 2 inventories, what should be the value of this machine in inventory presented in Brighty Company's statement of financial position at 31st December X9. So it is asking about the value of machine in inventory. Now let's read the scenario. At 31st December X9, Brighty has a bespoke machine in inventory that was manufactured to cater one of their clients' unique need. So they are actually manufacturing machine. So for a machine manufacturer, the machine will be inventory, not property, plant, and equipment. For a furniture dealer, furniture will be an inventory. For a computer dealer, computer will be an inventory. Likewise, for a manufacturer of machine, the machine will be an inventory. And the original cost of the machine was 500,000. The selling price of this machine has been agreed upon for $520,000. However, due to recent enactment of safety regulations, modification must be made to this machine at an additional cost of 80,000 before it can be sold. And the client has agreed to pay 40% of additional modification. That is, Brighty Company will have to take 60% of this cost from their pocket. So what is the value of this inventory? So as you know that inventory should be valued at cost or NRV, whichever is lower. So how much is the cost? The cost is very clearly given. The original cost of the machine was $500,000. And what is NRV? NRV includes estimated selling price, estimated cost to complete the sale, or estimated cost to complete, estimated cost to complete, or estimated cost to sell. Estimated cost to sell. So the estimated selling price is given in the question. The selling price of this machine has been agreed for $520,000. Now, if you have attended my classes, I have very clearly told you that in questions where cost is given and further cost is also given, that further additional cost should be considered as NRV. So here there's an additional cost required before it can be sold. So it is cost to sell. And the additional cost is 80,000. But if you read the question very carefully, you can say that the client has promised to pay 40% of this cost. That means Brighty will have to pay 60%. We are trying to find out Brighty. So Brighty will have to pay 60% of this. So cost to sell from Brighty's point of view will be 48,000. So 520,000 minus 48,000, that is equal to 472,000. So the NRV is equal to 472,000. So cost is equal to 500,000 and NRV is equal to 472,000. So 472,000 is lower. So inventory will be recognized at 472,000. So option B is the answer. Moving forward to the next question. Alpha company purchased new machine on 1st July X3 for 10 million with useful life of 10 years. The acquisition was partially funded by a 3 million government grant received on the same date. Using deferred income method of IAS 20, accounting for government grant and disclosure of government assistance, which two of the following show the values at which grant and asset will be presented in statement of financial position for the year ended 30 June 20X4. So the year ended 30 June X4. So the year will begin on 1st July X3, and the grant was received in the beginning of the year. And they are using deferred income method. So we have learned that in case of deferred income method, the government grant received will be recognized as a deferred income. And every year, an amount based on the depreciation method will be recognized in statement of P&L as income. The balance will be shown as deferred income, which is a liability in SOFP. This deferred income will have to be split into current liability and non-current liability. Current liability is the amount that will be recognized as income in SOPL next year, and the balance is non-current liability. So they're asking us to calculate how much is the non-current liability and how much is the current liability. And be very careful. The question is saying that which two of the following. So it's not a single answer. You have to select two options. So two options should be selected. So one is the deferred income, the liability in SOFP, and it's split into non-current and current liability. And the second, they're also asking you about non-current asset. So let's discuss that and let's try to identify what are the two items that have to be shown with respect to IAS 20 government grant in this particular question. So we start with the deferred income. So on 1st July X3, beginning of the year, government grant is received. We have learned that as per deferred income method, when the government grant is received, it should be recorded as deferred income. So the government grant received in the beginning of the year will be recorded as a deferred income. And the deferred income is $10 million. So the amounts in millions. In your examination, you'll be given a rough paper if you're writing center-based exam. So make use of that rough paper to scribble this. In remote exam, rough paper will not be available. You'll have to make use of the scratch pad. So at 30 June X4, the year end, an amount will be recognized as income in SOPL. An amount recognized as income in SOPL will be based on depreciation method. Since the question is silent, we'll have to assume it is a reducing balance method, and the government grant received was actually, sorry, that's a correction. The government grant received was actually 3 million. So the 3 million and amount recognized as income is 3 million, the grant divided by 10 years, the useful life. And don't forget about time proportion. In this case, since it is in the beginning of the year, we can show the entire income as income in P&L, the entire grant as income in P&L. So 0.3 million. So on 30th June 20X4, 3 minus 0.3 million, the balance 2.7 million will be recorded as deferred income in SOFP, which is a liability. Now this deferred income of 2.7 million should be split into current and non-current liability. Current liability is the amount recognized as income in SOPL in next year. Since depreciation is based on straight line method, every year the income will be 0.3 million. So the current liability is equal to 0.3 million. And the balance will be non-current liability. So the balance is out of 2.7 million total deferred income liability. 0.3 million is current liability. So the balance 2.4 million will be the non-current liability. So one of the answer is option B, non-current liability of 2.4 million and current liability of 0.3 million. But the question is asking which two of the following show the values. So there is two. So there is one more answer. Option A is not the answer. Non-current liability of 2.6 and current liability of 0.1 million is absolutely wrong. So B is the answer. The second one will be either a non-current asset of 9 million or a non-current asset of 7 million. So they're asking about the non-current asset. So on 1st July X3, Alpha purchased a new machine on 1st July X3 for 10 million. So there is a machine, there is a property, plant and equipment, there is a non-current asset having a value of 10 million. And at 30 June X4, the year end, this asset will be depreciated. So depreciation is equal to 10 million, $10 million, which is the cost divided by useful life 10 years. Don't forget about the depreciation. It has to be time proportioned. But in the given case, since the asset is bought on July X3, the beginning, you can take full year of depreciation that is equal to 1 million. So the value of the machine on 30th June 20X4 is cost 10 million minus 1 million. The carrying amount of machine, property, plant and equipment that is non-current asset is 10 minus depreciation 1, 9 million. So the carrying amount will be 9 million. So option C will be the answer, non-current asset of 9 million. So a non-current liability of 2.4 million, a current liability of 0.3 million, and a non-current asset of 0.9 million. Option B and C is the answer of second question. Moving forward, please do read the requirement of third question. What is the depreciation charge of locomotive engine in statement of P&L for the year ended 31st December X3? So the financial year ending is on 31st December X3. So the financial year will begin on 1st January X3. So 1st January X3 to 31st December X3 is the financial year. They're asking of depreciation of locomotive engine. So now let's read the question. Kentucky purchased a locomotive train on 1st July X3. So remember, the asset was not purchased or available from the beginning of the year. The locomotive train was purchased during the year on 1st July X3. So when you depreciate, you have to depreciate from July to 31st December. That is July, August, September, October, November, and December. So depreciation is from 1st July X3 to 31st December. So depreciation for 6 months, it need to be time proportioned. And the purchase price of the locomotive train was 975,000. The locomotive engine needs to be dismantled at the end of useful life of 7 years. At July X3, that is beginning, the cost of dismantling are estimated to be 150,000 at the end of the life of engine. The components of train includes the seat of train, which consists of 15% of purchase price, its exterior 45% of purchase price, and locomotive engine 40% of purchase price. The discount rate is estimated to be 6%. So locomotive train, they're not asking us the depreciation of locomotive train. They're asking depreciation of locomotive engine. which is 40% of purchase price. So this locomotive train includes three parts. One is there is the seats of the train, which is basically 15% of the purchase price. There is exterior, which is 45% of purchase price. And the third one, 40% of purchase price, the locomotive engine, 40% of the purchase price. So locomotive train, the cost of the locomotive engine, that is our question. Engine cost us 975,000 is the total cost of the entire train. Out of that, the question has given the locomotive engine is equal to 40% of the purchase price. So 975,000 into 40%. That is, you can use the calculator, which is given here. It will be a scientific calculator. If you just click the mode, you can make it to standard and just click on here and use your keypads. So 975,000 multiplied by 40%, that is equal to 390,000. $975,000 multiplied by 40 divided by 100 is equal to 390,000 is the cost of locomotive engine. There is one more item which the question has stated. The locomotive engine needs to be dismantled at the end of its 7-year useful life. And they have estimated the present value, they have estimated that cost is equal to 150,000 at the end of life of the engine. So we have to calculate the present value of dismantling. We have learned in Accounting Standard 16 property, plant and equipment, as well as Accounting Standard 37 provisions, contingent liability and contingent asset, provision for site restoration, provision for dismantling cost, provision for decommissioning, provision for landscaping, etc. will have to be added to cost of the asset. So the present value of dismantling after 6-7 years, they have given future cash flow 150,000. Now future cash flow multiplied by discount factor. Normally, they will give you the discount factor. Discount rate is 6%, which is basically for 7 years. Normally, that figure used to be given in ACCA exam. However, in this particular mock exam, ACCA has not given that rate, so we'll have to calculate that. How to calculate? The present value is the discount factor. The present value is basically, you might have learned, it is 1 divided by 1 plus R, that is rate of interest raised to N. So in this case, it is 1 divided by 1 plus R, in this case is 6% raised to N, that is basically raised to 7. That is 1 divided by 1 plus 6%, convert the 6% into decimals, 6 by 100, that is 1 plus 0.06 raised to 7. So it is basically 1 divided by 1.06 raised to 7 times. So how to find out that figure? You take 1 divided by 1.06, that is 1, divided by 1.06, that is 2, divided by 1.06, that is 3, divided by 1.06, that is 4, divided by 1.06, that is 5, divided by 1.06, that is 6, and finally the seventh one divided by 1.06, that is equal to 0.665. So 150,000 multiplied by discount factor 0.665. It is 1 divided by 1.067 times. So now this multiplied by 150,000. So 150,000 future cash flow after 7 years multiplied by 0.665, discount factor is 99,750. So the present value of dismantling is 99,750, and this is entirely for the locomotive engine. So the total cost of the asset is 390,000 plus 99,750. Cost plus present value of dismantling 489,750. 489,750. The question is asking about the depreciation. So depreciation is equal to this 489,750 divided by useful life, which is basically 7 years. And don't forget a time proportion from July to December, 6/12. So 489,750, that is a cost, divided by 7 years, multiplied by time proportion 6/12 is equal to 349,982. That's a small rounding of error. 34,383. Option D is the answer. So moving forward to the fourth question. This question is quite unique because this type of questions has been tested in SBR, not as a objective type question, as a descriptive type question. The same kind of information is being brought into FR. This is there in your FR syllabus, IFRS 13, fair value measurement. But this kind of detailed question is not there in normally asked in FR, but it's part of your syllabus. So what will be the fair value per car for daily in accordance with IFRS 13 fair value measurement? So they're asking about the fair value of the car. So fair value, you might have learned how to calculate fair value. Fair value is basically the market price minus transportation charge. Minus transportation charge. So now please read the question. Daily company has a fleet of 40 identical cars for which accountant wants to calculate the fair value. Daily has the option to dispose the car in the following market: London, Birmingham, and Manchester. Sales price per vehicle in London is 5,000, Birmingham 3,500, and Manchester 6,000. Last year transactions of daily company 10,000, 60,000, and 28,000. Total volume of transactions in the market: London 400, Birmingham 500, and Manchester 450. Transportation cost per vehicle 350, 100, and 500. And transaction cost per vehicle is also given. You have learned that in IFRS 13, if an entity can sell an asset or settle liability in multiple markets, we'll have to consider which is the principal market. Principal market is a market in which there is maximum activity for the asset. So the total volume of transactions in the market, the maximum cars are being sold in Birmingham. So Birmingham will be chosen as the principal market. 500,000 is the highest one. So fair value should be based on principal market, that is Birmingham. So you have to pick out the information for Birmingham market. So what's the market price in Birmingham? The sales price per vehicle in Birmingham is 3,500 minus transportation charge. Transportation cost is 100. Don't take transaction cost. Transportation charge is 100. So 3,500 minus 100, that is equal to 3,400. This is a new type of question that has been tested in your FR exams. So 3,400 is the answer. Moving forward, it's a ratio analysis related or interpretation of financial statement related question. The operating profit margin of Springs company has dropped from 20% for the year ending 31st December 20x1 to 16% for the year ended 31st December x2. So operating profit margin has decreased. Which of the following factors could have led to this decrease? So if operating profit margin has to decrease, there could be two reasons. One, the operating profit, that is PBIT, has decreased. Operating profit, that is PBIT, has decreased. Or revenue has decreased. This could be the reason for decrease from 20 to 16. So one, Springs debt financing provided increase the interest rate on the company's loan. You have to understand that operating profit is PBIT, profit before interest and tax. So the increase or decrease of interest will not affect PBIT because it is profit before interest and tax. And operating profit margin is PBIT or operating profit divided by revenue. So definitely interest will not affect operating profit. So that is not the answer. So option A is not the answer. So we can strike through it. B, after conducting a review of tangible asset, Springs company decided to reduce the useful life of its machine and equipment. So if they are reducing the useful life of machine and equipment, what will happen to depreciation? Will it increase or decrease? Let's see that. Let's put some figures to understand that. So let's say depreciation is based on useful life of 4 years. So 100,000 divided by 4, depreciation will be 25,000. Now let's say the management decides to reduce the useful life from 4 to 3. So what will happen to depreciation? 100,000 divided by 3, depreciation will increase to 33,333. If depreciation increase, what will happen to profit? If depreciation increase, profit will decrease. So depreciation will increase and profit will decrease. So definitely that's a reason. The useful life has changed. The useful life has decreased. If useful life decrease, depreciation will increase. If depreciation increase, profit will decrease. If profit decreases, the operating profit margin will decrease. So we got one of the reason. Second one, Springs company was able to negotiate better deals and obtain price reduction on raw material purchase from supplier. If their purchase of raw material, if there is price reduction, if purchase is low, or if purchase has decreased, the purchase expense has decreased, what will happen to profit? Profit will increase. Profit will increase. So if profit increase, operating profit margin will also increase. That is not the case in this case. So this is not the answer. Now, then the last one will be the answer, but let's read it. Springs company increased wages of its managerial staff in response to new government policies. Wage increase. If wage increase, profit will decrease. If profit decrease, operating profit margin will also decrease. So option B and D is the answer for operating profit margin to decrease. Now, the sixth question. Please read the requirement. Calculate the gain on investment to be recognized in IRINGA's statement of P&L and other comprehensive income for the year ending 31st December X6. So some gain on investment is being tested. So please read the question. On 1st April X5, IRINGA company made an investment in ordinary shares of Brown Company, paying $10 million for the shares and an additional $1 million in broker fees. The shareholding was less than 2% of Brown Company's ordinary share capital. So this happened in April X5. Our financial year ending is on 31st December X6. So the corresponding or the relevant financial year for this particular question start on 1st January X6 and ends on 31st December X6. So whatever happened on April X5 is last year, previous financial year, not a botheration for in this particular question. Continuing that, IRINGA made irrevocable election to classify investment as fair value through other comprehensive income. At 31st December X5, the fair value of investment was 12 million and it was correctly accounted. So 31st December X5, the fair value is 12 million. The investment is being recorded at fair value through OCI, meaning the investment will be recorded in SOFP at fair value. So 31st December X5 fair value is 12 million, meaning on January X6, that is the opening balance of current year, it will have a value of 12 million. That is the value that we require for this solving this question because January X6 is the opening balance. And it was correctly accounted. On 30 June X6, that is during this year, and at 31st December X6, IRINGA company sold entire investment for a cash consideration. So this was sold at a price for 13 million. So a 12 million investment was sold for 13 million. That means the entity made a profit of $1 million. So that is a gain to be recorded in profit and loss account, $1 million. That's it. Simple. Seventh question. What would be the finance cost in respect of property lease in hybrid statement of P&L for the year ended 30th June X9? To be very careful with the dates given. Financial year ending on 30 June X9, and they're asking finance cost with respect to lease. And if you read the question, you can see that it started in July X7. That means we have to calculate figures for 2 years. July X7 to 30 June X9, 2-year figures. Hybrid company acquired commercial property through a 10-year lease. The information below is relevant to this contract. On July X7, an initial lease payment of 8 million was made. Annual lease payment of 16 million are due on 30 June each year in arrears. The implicit rate of interest is 6%. The present value of lease payment on July X7, that is beginning, before initial lease payment was 100 million. So what is the finance cost is what we have to calculate. So it's all about knowledge in IFRS 16 lease. So the lease starts on 1st July 20X7, initial lease liability. You know that how to record initial lease liability? Present value of annual lease payment. And how much is that initial lease liability? How much is the present value of lease payment? The present value of lease payment on 1st July X7 is 100 million. Is 100 million. Now the year end is 30th June 20 X8. Now annual lease payments are due each year in arrear. Arrear means it is at the end of the year. So if it is at the end of the year, first we have to add interest, then deduct annual lease payment. So plus interest or finance cost, 100. But before that, before you go to that, there is a very important information in this question. On 1st July X7, an initial lease payment of 8 million was made. There is an initial lease payment on July X7, and the question very clearly says that this 100 million, the present value of lease payment, is before initial lease payment. So on July X7, you have to reduce that initial deposit on July X7 less initial deposit. Less initial deposit, it's 8 million. So now on July X7, after the initial deposit, the lease liability is 100 minus 8, that is 92. Now multiplied by, it's not 100, it's 92 multiplied by, how much is the implicit interest? 6%. So 92 into 6% is equal to, you can use the calculator to find it out. 92 multiplied by 6%, 5.52. So interest rate implicit in the lease or interest is 5.52. And on 30 June 20X8, annual lease payment is given 16 million. So the interest we just found out is 30 June X8. The question is asking 30 June X9. So now use the calculators. 92 plus 5.5, 92 plus, 92 plus 5.52 minus 16 is equal to 81.52. So that is the lease liability on 30 June 20X8, or we can say on 1st July X8 if you're thinking from the opening point of view. So I'm just writing LL, lease liability 81.52. Now at the end of the next year, on 30 June 20X9, since annual lease payment is paid at the end of the year, first interest will be calculated. So interest is 81.52 multiplied by implicit interest rate 6%. So 81.52, the lease liability multiplied by 6% is equal to 4.8912 million. So this have to be shown in entire millions dollar value. So 4.8912 million will be 4,891,200. Always be very careful with the year end. You have to calculate for 2 years. Next question. It's quite an interesting question. It's a consolidation question, but quite interesting. What was the amount of cash consideration paid by Diamond Company for the investment in Sapphire Company? So they're asking how much is the purchase consideration. Now, please read the question. On 1st May 20X5, Diamond Company acquired 75% of ordinary share capital of Sapphire Company through initial cash payment. And they're asking how much is the cash payment and agreement to pay contingent consideration to shareholders of Sapphire Company. The fair value of contingent consideration was assessed to be $350,000 by Diamond Company on this date. Diamond Company calculates non-controlling interest using fair value at the date of acquisition, which was estimated to be $150,000. The goodwill arising on acquisition was calculated to be $400,000. The following figures of Diamond Company are relevant. Ordinary shares of $1 at acquisition 600, retained earnings at January X5 350, profit for the year ended 31st December X5 140, profits for Sapphire Company have accrued evenly throughout the year. What was the amount of cash consideration paid by Diamond is the question. And be very careful, it was acquired on 1st May X5, not in the beginning of the year. Because the financial year ending is on 31st December X5, and the subsidiary company was acquired during the year. They're asking how much is the cash consideration. In fact, they have given purchase consideration information, fair value of NCI information, net asset information, as well as goodwill. So once you input that in the format of goodwill and do the reverse working, you'll be able to get the purchase consideration. It's also a kind of new question. This kind of question has been asked in your examination, I think one time before in one of the FR examination. And a similar kind of question is also there in SBR exam as well. So how do you calculate goodwill? Goodwill is basically purchase consideration at date of acquisition. And we do have here cash consideration is there. Cash consideration. And we also have contingent consideration, which have to be calculated at fair value. So fair value of contingent consideration, you don't have to calculate, it's given. The question is asking us to calculate the cash consideration. That is a question. How much is the fair value of contingent consideration? It's very clearly given. The fair value of contingent consideration was assessed to be $350,000 on this date. On this date means on date of acquisition, 1st May. So contingent consideration is $350,000. Then purchase consideration, that is cash consideration and fair value of contingent consideration, add fair value of non-controlling interest at date of acquisition. How much is the fair value at date of acquisition? It is given in the question, fair value of date of acquisition was estimated to be $150,000. That is also given. So fair value of NCA at date of acquisition is $150,000. Then less net assets of subsidiary company at date of acquisition. So how do you calculate net asset of subsidiary company at date of acquisition? We have share capital, share premium, retained earnings, revaluation surplus, any fair value adjustment, etc. In this question, they have given two information. One, ordinary shares is 600,000. So share capital or shares is 600,000, and then retained earnings. Now you have to be very careful. We need to find out retained earnings at the date of acquisition. Those who have attended my classes, we have done almost 10 past question papers in my classes, certain as homework and certain questions in the class itself. And I've told you, there's an area where many students do confuse and get wrong answer. I don't know why. The retained earnings is pretty much simple. If you're still confused, listen very carefully. Retained earnings, we have to find out retained earnings at the date of acquisition for the purpose of calculating goodwill. So retained earnings, we need to know what is the retained earnings on 1st May 20x5. That is the date of acquisition. And I've told you several times in our class that a date will be given. Retained earnings, a particular date will be given. You write that date. Retained earnings at 1st January x5 is given. Okay. Then on 1st January 20x5, retained earnings is given. How much is that retained earnings? 350,000. We need to find out retained earnings as on 1st May 20x5, which is date of acquisition. What you have to do, the difference between two retained earnings is simple. It's profit. All you have to do is add profit. Add profit from 1st January to 1st May. Add profit from 1st January to 1st May. How many months are there? January, February, March, and April. Don't take May, it's only one day. So we have to add 4 months profit. And profit is given, profit for the entire year ended 31st December x5 is 140. So 140 into 4 by 12. So use your calculators to find it out. 140 multiplied by 4 by 12 is equal to 46,666,000. So 46,667. So now the retained earnings at date of acquisition is 350,000 January plus profit for 4 months. So retained earnings at date of acquisition is 396,667. So we got retained earnings at the date of acquisition as 396,667. So how much will be the net asset? So the net asset will be shares, equity share, capital 600, and retained earnings at date of acquisition 1st May x5, 396,996. So it will be net asset at date of acquisition is equal to 996,667. Now, once you do all of those things, purchase consideration plus fair value of NCI at date of acquisition minus net asset of subsidiary company at date of acquisition, what will you get? You will get goodwill. You don't have to calculate because the question has even given that goodwill arising on this acquisition was 400,000. So goodwill at the date of acquisition is 400,000. So then what we have to calculate, read the question very carefully. They're asking how much is the cash consideration. There are two consideration. One is cash consideration and second one is contingent consideration of which value is given. So all this value is there. Contingent consideration value, NCI date of acquisition, 996,667. It should become 400,000. So what is the cash consideration? Reverse work. You do the reverse work, goodwill, 400,000. Now, goodwill is what you get. So work reverse, work backwards, then you will get the answer. This minus 996,667, when you work backwards, will become positive 996,667. This 150,000, which is positive, when you work backwards, will become negative. And this 350,000, when you work backwards, it will also become negative 350,000. Now use your calculators. The goodwill 400,000. Final answer, working backward, plus 996, 667. That is net asset of subsidiary company at date of acquisition. Then minus NCI at date of acquisition, 150,000, minus purchase consideration, which is the deferred contingent consideration fair value, 350,000, equal to 896, 667. Option D is the answer. Moving forward to the 9th question. What should be the amount of warranty provision in Walker's statement of financial position on 30th June 20X5? Walker Company's year-end is 30 June X5. Walker Company provides a 1-year warranty with each product sold during the year. Past experience indicates that no repairs are required for 80% of goods sold by Walker. On average, 15% require minor repair and remaining 5 require major repairs. Company's service manager has estimated that if minor repairs were required for all products, the cost would be 120,000. And if major repairs were required for all products, it would cost 1.2 million. What should be the amount of warranty provision in Walker Company's statement of financial position on 30th June 20X5? So, minor repair and major repair. How do you calculate warranty provision? It is based on expected value. What is expected value? Future cash flow multiplied by probability. And the question says that if minor repair is required, the cost would be $120,000. And if major repairs is required, it would cost 1.2 million. And what is the probability for minor repair? The probability for minor repair is 15%. So $120,000 into 15%, that is equal to, use your calculators, it is $18,000, $18,000. And for major repair, 1.2 million. And what is the probability for major repair? 5%. So multiplied by 5%. So 1.2 million into 5%, that is equal to 60,000. So the total provision that is required is 18,000 plus $60,000, that is $78,000. Option A is the answer. Now, 80% does not require any repair at all, so there is no future cash flow for that. So it's as simple as that. Question number 10. How will this change in accounting policy impact financial statements of Gillard Company for the year ending 30 June 20X2? So read the question. Gillard Company applied cost model for its investment property from many years. Starting from 1st July 20X1, the company shifted to fair value model for investment property. Since fair values were higher than carrying amount for all investment property, a fair value gain of 40 million was recorded in financial statement. There is no change in estimated useful life of investment property. How will this change in accounting policy impact financial statements of Gillard Company for the year ending 30 June X2? Both operating profit margin and gearing will increase. Both PBT and gearing will decrease. PBT will increase and gearing will decrease. PBT will stay same while gearing will go up. So the question is that how does changes will affect operating profit, or how will it affect PBT, and what will happen to gearing is the question. So Gillard applied cost model for its investment property. From July X1, that is beginning of the year, it is shifting to fair value model. Cost model to fair value model is a change in accounting policy. Since fair values were higher than carrying amount, a fair value gain was recorded. So if a fair value gain is recorded, then it will be shown in investment income, which will increase PBT, which will definitely increase PBT. And what about, there is no change in estimated useful life of investment property. What about gearing? How do you calculate gearing? Gearing is basically debt divided by equity. So if profit is increasing, that increase will also get reflected in retained earnings. So retained earnings will increase. If retained earnings increase, retained earnings is part of equity, equity will also increase. Equity is in the denominator of gearing ratio. If denominator increase, the ratio decreases. So gearing ratio will decrease. Gearing ratio will decrease. So the answer will be profit before tax will increase and gearing will decrease. So option C is the answer. Now the next question is that, sir, why are we not considering operating profit here? For that, you have to understand operating profit is based on PBIT. To understand the format of SOPL, revenue less cost of sales, will get gross profit, less operating expense, which is selling and distribution expense and admin expense, you get operating profit or PBIT. After operating profit, we show investment income, which is where we show fair value gain of investment property. So the investment income increasing or decreasing will not affect operating profit, but it will definitely affect PBT, because investment income, then finance cost, then we will get PBT. So investment income increase or decrease will affect PBT, not operating profit. The next question, which of the following terms represent entry price at which entity would acquire the asset or incur liability at current market price? That is pretty much simple, straightforward. Current cost is the cost at which entity will buy an asset. 12th question, in accordance with IAS 10 events after reporting period, which statement is correct regarding dividends declared after reporting period, but before financial statements are approved for issue? So what is the treatment of dividend declared? Dividend declared actually should be shown as a liability if it is declared at the year end. But here the dividend is not declared at the year end. It is getting declared after the year end. So how you have to treat dividend declared after the year end? It is not a liability at all. You can show it as a non-adjusting event and disclosing notes to financial statement. They should be recognized as a liability. No. They should not be recognized as a liability at reporting date. That is correct. They should be considered as an adjustment to post-reporting date events. No, they are not adjusting event. They should be recognized as an expense. No. So basically, dividend declared after the year end should not be recognized as a liability Option B is the answer. Now, a few points regarding that. Proposed dividend will be disclosed in notes to financial statement. Dividend declared by shareholders will be shown as a liability when it is declared. So this is getting declared after reporting date. So you cannot show that it as a liability at the current year. So it should not be recognized as liability at the reporting date. You can show it as a non-adjusting event and disclose in notes to financial statement. It is not given in the question. I simply discuss the treatment of dividend. Now, what is the diluted EPS of Charlotte Company at 31st December X5? Previously, there was a mistake in this question, and ACCA has now rectified that mistake. Charlotte Company has issued share capital of $5 million on January X5 at a par value $1 per share. On 1st September X5, Charlotte made a bonus issue of 2 new shares for every 5 shares held. Profit after tax is $756,000. Charlotte has convertible loan note of $300,000 issued at 5% interest rate. The loan can be converted into 60 shares per 100 after 5 years. Tax rate is 30. What is diluted EPS? So convertible loan note. There's a convertible loan note. In case of convertible loan note, how will you calculate the diluted EPS? So diluted EPS is equal to profit after conversion divided by number of shares after conversion. And how do you calculate profit after conversion in case of diluted EPS? Basically, there are 3 steps to it. One, we start with profit after tax, which is given in the question. The profit after tax is $756,000. And once shares are issued, then entity won't have to pay interest. So as a result of that, the profit will increase at interest saved by converting this loan note into equity. How much is the amount of loan note? 300,000. And what is the interest rate? 5%. So how much interest will be saved? It's 15,000. So accordingly, profit will increase. But when interest saves and the profit increase, there will be tax to be paid on interest savings. So tax on interest saved is equal to 15,000 multiplied by 30%, 4,500. So now you can use your calculators to find out this answer. So profit after conversion is equal to 756,000 plus 15,000 minus 4,500, which is 766,500. So we got profit after conversion is 766,500. Now we have to calculate number of shares after conversion. So number of shares after conversion, you can either we start with opening shares, or if there is share issue during the year, it should be based on weighted average number of shares. So here there was a share issue, which is bonus share. So share issue during the year. So weighted average plus add shares issued on conversion of loan note. So how do you calculate weighted average in case of a bonus issue? That is very simple. We start with the opening, and bonus issue is always assumed to be done in the beginning of the year. You can either use the bonus factor or simply start with the opening number of shares, which is given 500,000 plus bonus issue 5 million multiplied by how much is the bonus issue? 2 new shares for every 5. So multiplied by 2 by 5. So that is equal to 5 million plus 5 million into 2 by 5 equal to 2 million. So that is equal to 7 million. So weighted average number of shares is equal to opening plus a bonus issue 7 million. Add shares issued on conversion. So how much is the loan note amount? 300,000. And how it is getting converted? The loans can be converted into 60 shares per $100. So 300,000 divided by 100 into 60. So you can use calculator for that. So 300,000 divided by 100 multiplied by 60, that is 180,000. So shares issued for consideration is equal to 180,000. So shares issued on conversion. So total number of shares after conversion, is equal to 7,180,000. So we have now got all the information to calculate this. So profit after conversion is equal to 766,500 divided by 7,180,000. 7,180,000. So 766,500 divided by 7,180,000 is equal to 10.67, that is 0.11 cents. The second last question. On December X3, Leslie sold 2 million of trade receivable to Riley Company. Leslie Company received an immediate payment of 1.8 million. Under factoring arrangement, any receivables not collected after 6 months will be sold back to Leslie. So this is basically a factoring arrangement with recourse. The risk and reward is not transferred. So if risk and reward of bad debt or irrecoverable debt is not transferred, then any cash receipt will be recorded as a financial liability. So straightforward, the cash receipt of 1.8 million should be treated as a loan. The last question. Which two of the following conditions allow a company to be exempt from consolidation according to IFRS 3 business combination? The ultimate parent produces financial statement available for public use that comply with IFRS. Yes, exemption. Subsidiary trade in a distant foreign country and prepares account in a foreign currency. That is not the reason for exemption. The company is a wholly owned subsidiary of another entity, and its other owners do not object to parent not presenting consolidated financial statement. Yes, if the shareholders don't object for not preparing consolidated financial statement, then that company is exempt. Its business nature is different from that of parent and rest of group. That is not the reason for exemption. So option A and C is the answer. So thank you, everyone. All the best for your September 2024 exam. Don't forget to subscribe to this channel and press the notification button, because from time to time, I upload the mock debrief of FR, audit and assurance, as well as in future SBR. So when you reach AA or SBR, you can use my debrief and other videos for your examinations. So don't forget to subscribe to this channel. Goodbye. Have a nice day and all the best for your September 2024 exams.